Hello folks, welcome back. Hopefully you've had a restful previous week off. I appreciate you guys being understanding in regards to my personal life and the time I request off. The next time that we do this will obviously be around the holidays at the end of the year, so we should be business as usual up until then. Alright, so we are looking at the economic calendar for the week that we are presently in. The time of this recording is April 13th, 2020. And the only information we had that was hitting the wires for the economic calendar was 9:30 p.m. for tonight. Medium impact business confidence for Australian dollar. Tomorrow, all day, we have G7 high impact for every currency. So they'll most likely give us some momentum in areas and during the kill zones. Wednesday, 8:30 a.m., we have high impact core retail sales. And 10 a.m., we have high impact Canadian dollar, monetary policy report, rate statement, and overnight rate. Then 11:15 a.m., we have the press conference. This is all CAD based. So the Canadian dollar market should be rather eventful on Wednesday. 9:30 p.m. Wednesday, high impact employment change and unemployment rate for Australian dollar. Then Thursday, London Open credit condition survey for GBP, medium impact, and then 8:30 a.m. medium impact manufacturing sales for Canadian dollar, and then high impact unemployment claims. That number will probably be horrendous again. Building permits, medium impact for dollar, and Philly Fed manufacturing index. And then Friday we have an absence of any real economic data. So let's transition over to the charts and see what we have. Okay folks, here is our daily DXY or US dollar currency index. And you can see last week we had a little bit of weakness come in, roll over from the top of the fair value gap in here, reacting off of the complete fill in here. And while I was expecting rather it not to go above the midpoint or consequent encouragement of the balanced price range, the imbalance, once rebalanced, it did allow the dollar index to trade lower. Nothing in here in terms of imbalance that's overly suggestive of importance. I think we have the liquidity pool resting below here. That's the next draw on discount, or the next lower level draw on liquidity. We could pop up if we get any kind of retracement tomorrow or into Wednesday. We could see 99.80, 99.85. In other words, we want to see basically 100 be preserved, okay, and defended. It could trade up into the bearish order block here, but all I'm doing is waiting to see if it has willingness to get back to the bottom of the balanced price range. And looking for a run to the low of 98.25. Okay, so that's our next discount array in the form of a liquidity pool here. And then if we should get below that and accelerate below the 98 big figure, we're looking for 97, 97.10, which would be consequent encroachment of the BISI that's here. Okay, and I'll take this off. You can see what's being framed. Okay, so it's this buy side imbalance, sell side inefficiency. And that's the consequent encouragement midpoint of that. So ultimately we're looking for it to trade, I'm looking rather for it to trade to 97 and allow upside for foreign currency still to unfold. Okay, so let's go over to the hourly chart. Okay, so here's our hourly DXY or dollar index. And we see the reaction here at the top of that balanced price range. The market breaks down, finds some support at the bottom of that balanced price range, trades back out to consequent encouragement between this level and this level. Go back out to the daily chart again and look at the previous recordings. Consequent encouragement here, trades back up above the rejection block, which is the highest up close candle, and the close. Okay, so it trades above that, rejects, trades back down. Once more, rejection block. Here's the close, 100.20, and the high on this candle comes in at 120. So it just matches the rejection block there. Trade softer, and we've consolidated, moving into the imbalance that resides right here. Let's put a little lipstick on this so you can get a better appreciation for what's being seen. Okay, so you can see beautiful price delivery, rebalancing the BSI down to a bullish order block. Prices moved up, cleared buy side liquidity. And does it want to come back up to the bottom of that balanced price range on the daily chart? That's what I'm watching to see. It's better if it doesn't and just trades softer and makes an aggressive run below these lows and doesn't just dip below it and then come back up into this balanced price range. Once we get through this again, these two levels here become a balanced price range, and we would expect price to be kept below 99.15. Okay, so any movement below here sets the stage for a run below the 98.40 level, and then back to what we were outlining on the daily chart. Moving into the 15-minute time frame. Okay, so here's the 15-minute time frame on the Dixie. Let me get a little bit more on this chart. There we are. So right away, we have an imbalance that resides right here. So it could come back up, clear the buy side liquidity that rests here, that just flirted with it really. I just want to put a line on here that I'm going to remove as soon as I annotate it. But if you look at this, you see they left that and that intact with the premium array in the form of a SIBI, sell side imbalance, buy side inefficiency. So the focus tonight into tomorrow resides in here. So we'll see if there's any kind of willingness to get up in here. Consequent encroachment could be 99.70, 99.75. A complete rebalance would be 99.78. But it could be drawn as far as to the bottom of that daily balance price range, which is the blue line here. Again, go back to the daily chart and you'll see what that is. So they could run both these relative equal highs because there's going to be buy side liquidity resting above that. If they pop through that and hit this and then we get weakness, then everything I've outlined on the daily chart would be what my expectations would be for the rest of the week. But this is the scenario I'm mapping out for that to occur. Ideally, we want to see it not even make a run above that and just leave these here, because that would indicate what? Exceedingly weak price for dollar. So if it doesn't even want to have any parts of going back above these relative equal highs in here, that only suggests one thing. It's just too weak to consider even looking for that. So therefore, large ranges should be in play for down closed candles on the daily chart, if that is what we see. Okay, so it's one of those things you want to have in your notes. If we don't see equal highs ran out when we're bearish, that's exceedingly bearish. That means it's so overwhelmingly bearish. They're not interested in going back because they don't want to. They've already padded themselves out, if you will, with enough shorts. So there's no necessity for them to get back in. Usually this is done algorithmically. Automatically this goes up. But once in a while, they will step in manually and just keep a level intact. And that, in my experience, has been the only time really, except for when like geopolitical war breaks out, something like, like this pandemic, or plandemic, if you want to look at it that way. All the things that's going on right now, they could step in there and manually override what the algorithm would normally do in terms of offering liquidity, moving from discount to premium arrays. This, when it's left intact, and it's the same thing as when we see relative equal lows when it's bullish. Okay, if relative equal lows aren't rated and it just continues to rally, then that means that you really have a strong market, and they're not allowing the price to go back down below here. Okay, because usually the algorithm will run above these equal highs, even if it's bearish. They'll clear these and then go lower. It doesn't mean that it's automatically going to go above these highs and then go lower. It just means that if it does in fact unfold and it is bearish, any market, it's better for it to run above here, take some buy side liquidity, offer for smart money to accumulate more shorts at that point by pairing shorts with residing buy orders in the form of buy-side liquidity. That's the normal institutional order flow that we would expect to see in price and how price would deliver in a bearish market. That changes when we have a condition where if we are bearish and they aren't willing to go back to take those buy-side liquidity out, that means that you're in a really decidedly bearish environment. And then if that's the case, then it's real easy to anticipate large ranges on the downside. So that's what you're watching this week to see if we get these areas in here and how we trade there once we get there. And if we don't get there at all and it trades lower, then we should see some pretty large ranges on the downside for dollar. All right. So, and again, that's relative to its daily chart. So I'm going to keep these two lines in here just for lipstick purposes. And let's go to euro dollar. All right, so here is the euro daily chart. And not a whole lot's happened since last week or the previous Friday. So in other words, last week we were pretty quiet, didn't do a whole lot of movement in here. The low here, we got some reaction off of that. Nothing really in terms of rebalancing. Just as a mental note, I know I disclosed that between euro and British pound was my favored market on the upside, and any shorting would be ideally done in euro because our analysis, or my analysis, was shared with you on the euro pound, and I gave you those ideas about that. So if you've not wrote those ideas about the euro pound and what my expectations were and how that relates to how it was delivered or should have been delivered in price between euro dollar and cable last week, even though I wasn't participating, go back and look at that recording from, what would that be? That would be your recording from the 4th. Yeah, so the recording on the 4th of April, that weekend review, then watch that video again. And you'll hear me talk about what I'm going to talk about here. So we did have the sell-off at the middle of the bearish order block here, and that's what I'm highlighting that. Okay, so it just got a little overzealous with that line, and if we got above that, we would look for it to rebalance here and then judge whether or not dollar was going to be bullish or bearish at that point. I was unclear overall on directional bias for last week. I mentioned that before we had our time apart, and it hasn't really done a whole lot. And I said historically, the week of Passover generally is a really quiet week, and there's a lot of Jewish money in the marketplace. And these holidays tend to be, well, when the market just simply doesn't do a whole lot, okay? And I'll leave you to study that on your own and see if there's any validity to it, but generally it's usually a low volume week. But because of all the things that were going on, I kind of prefaced all that with saying it could be impactful. Okay, in other words, if there was low volume and then there was events happening around the world or something even worse happened, okay, that no one's really expecting, they could gap the markets pretty horrendously. And that was one of my reasons for kind of prompting you, just simply don't do anything, okay, because there's no reason to place all the emphasis on you being able to trade just that 1 week, okay, because I'm saying I'm not participating. A lot of you, and it's usually the young bucks in here, they want to arm wrestle that. Well, if ICT doesn't do it, if I do it, that means I'm a better trader, or I'm superior or whatever, okay? And I did that kind of stuff when I was younger. It's just dangerous. Don't do it. I'm not going to give you a high five if you did it or didn't. I just basically want you all to preserve what you have and don't take unnecessary risks, okay? All right, so that's that. That's the only jawboning you're going to get in this video, I promise. So we have reacted off of this low here. And if we go out, let me zoom out a little bit because I want to get, again, just for the completeness sake and continuity, a bunch of you new folks in here. This level here is the bottom of this BISI. Okay, if you go back and look at older recordings, we talk about this area here all during the month of February, and this area down in here. if I'm not mistaken. I think it's relative to its weekly chart. And I think it's the weekly bullish order block. Yep. Here's your weekly open on this down close candle. So that's what that is. And then here's your BISI here. Okay, so a single one candle up. That's what we're looking at, that level there. So that's, again, showing sensitivity and how by knowing these arrays in history, they repeat and they offer tradable bounces. And it's not, oh, it bounced here before. Standard support and resistance theory is completely subjective. What I'm teaching you is how the algorithm is remembering specific levels and why those specific levels are important. Because if you look at it this way, you have this high here, this high here, this high here, this high here. Which one's going to get a reaction? You see? It becomes like potluck. Like, which one is it? When you have this reaction here, we anticipate seeing a reaction like that when we go to an old BISI that's filled in, which is what that is here. Okay, there was another higher level that creates the top of the BISI that I outlined on that weekly chart, and daily chart rather, that I zoomed out. And you'll see them in our older charts, but I kept this one intact because it was salient. It is available when we were coming back down into the marketplace. This level could be reactionary, okay? And while I didn't draw too much attention to it in the commentary, you know, because of the things I've been teaching you relative to imbalances and fair value gap, okay? It's not liquidity voids, okay? It's not supply and demand. It's not all this other mumbo jumbo that's out there, okay? It's real price delivery based on how the interbank algorithm seeks to find specific price levels for rebalance, okay? And they don't just expire because they've been filled before, okay? So we're beyond, you know, other mentors out there. The concept of understanding what you're learning here gives you framework to all types of trading. You can be a scalper, a day trader, a short-term trader, swing trader, position trader. Relative to what your personal taste is or your personality aligns with in terms of those styles or approaches to trading, it's not my goal and it's no one's ability, really. No mentor is going to have the ability to form fit everyone into all of those disciplines of trading. It just isn't going to work. So there's a lot of personal discovery that's going to have to take place, not only in this mentorship, but anything else you do. If you've gone through other trading teachers and traders that, you know, share, if they have a winning system for themselves, many times if you try to take that and duplicate it by bringing other people into their fold and say, okay, this is how I do it, readily people come in and they think that that's going to be how it works. You know, everyone has this cookie cutter approach and anyone can do it just like that. And they discover many times with a great deal of adversity internally, okay, because they struggle with this, they can't bring their personality to align with that school of thought. And it doesn't diminish that particular person's ability to be profitable or consistent. It just means that you personally can't align with that. So that's what sets me apart from all the other ones out there, is I have a method that will make you consistent, but the job and role is ultimately your responsibility to first determine what your personality is most aligned with. And don't be discouraged if you're coming through the mentorship. If you're coming in new, you know, even before month 5 content, anyone below, you know, month 5 content is like a divider here. If you haven't got to month 5 content and all the lessons and, you know, theory behind everything up to that point, you really don't have an understanding of what you're trying to do, because you haven't been met with the minimum expectation of your understanding that should have been gleaned from all the free stuff. When you get to month 5, that's when it really starts to become new, like it's new stuff there, okay, new ICT content. And I broaden your understanding, so when you start seeing that content, then you'll get a better feel for, okay, I think I'm going to be pulled away from what I thought I was going to be when I first started doing this whole trading thing. And whereas I thought I was going to be a day trader, now I'm more comfortable with the idea of being a short-term trader. Or vice versa. It may be that you wanted to be a longer-term trader, but now you're like, wow, you know, I can see these short-term setups, and I can find time in the day to do that. And you don't Don't be discouraged if that impulse is happening, and you're going to move from one thing to the next, and that's a normal thing. But everything you learn here is universal. So if you grow an affinity for one style, okay, just pick one that you're most comfortable with that aligns with your personality. And over time, you're going to learn by experience how you can graduate into other disciplines when all you're doing is simply looking at a different time frame, and then allowing your personal personality and unique feel while engaging in the marketplace, because that's all going to be dependent upon how you internalize risk, how you are comfortable assuming risk, and your patience factor. And all of us have different measures of that, and it's going to be highly crucial to your results here or anywhere else, because no one can take you or anyone else and say, all right, here's what you're going to do. You're going to take this information, do this, and everybody gets the same results. It doesn't work that way. It does not work that way, because you're going to bring into my content your own interpretation of how it mixes and matches with your views about things, okay? I'm going to give you baseline rules and general principles, and they will serve you well, but they will not be concrete and ironclad, format. They're going to be bent by you to formulate something that's unique for you, not throwing everything out the window, not reinventing my concepts, but you're going to find that blending certain things with your specific personality, it's going to feel like you created something. And that's a good feeling. That's a good feeling, because what you're doing is you're creating your unique model with my tools and concepts. And there's nothing inherently wrong about that. I just don't want you going out and thinking that now you created a new wheel and you can now teach it and change the name. Okay, because that ain't going to float. Okay, so anyway, looking at the euro dollar, we haven't seen a whole lot of movement, but if we were able to get above the buy side liquidity pool here, we were mentioning that we could potentially trade there. It looks as if euro is still trading in that range. It may stay between 107, 75, 77-ish and 111 and allow cable to rally. And we'll talk about cable in a couple minutes. And that would allow for euro pound to decline. Right now, it looks as if between euro and cable still has my attention for upside. And euro is going to be the better short if there's any pop movement higher, a retracement higher on dollar. The better short will occur on this pair, but have it in mind that it's not going to likely deliver a great deal of magnitude. Okay, you don't want to be shorting pound dollar, but if there's a short based on dollar going higher, it's better to focus the short on this pair, because we're framing our context on the analysis from the euro pound. Okay, euro pound's likely to trade lower, so therefore euro is the first currency in its pair name, so it's more likely that that pair will not see relative strength on the upside. It'll see relative strength on the downside and allow relative strength on the upside for cable. And rewind that if it didn't make any sense, because I promise you I said it correctly. All right, so let's go over to the hourly chart for euro. All right, so here's euro. Price consolidated and didn't get much. I remember I was going back into the recording I gave you for the weekend of the 4th of April, and I said that this could have been a terminus, right? This could be your level. I felt that it could potentially go a little bit lower than that, but it only went lower by this low here. Okay, let me get this. This is driving me nuts. I hate when it does that. That's the only thing about TradingView I don't like. If you get down here towards the end, you get these things popping up, and I wish there was a way to not see them. If you know a trick or whatever to keep things from popping up, I'd greatly appreciate that. But if it can't, whatever. But it went below this low here just a little bit, and then ultimately showed some willingness to go higher. Now, notice how price traded on the hourly chart here on euro. Okay, so we saw weakness on dollar relative to its daily chart. Wonderful. Price has moved higher on euro, but look how it traded higher. Did it go up decisively stronger than cable, as we will look at in a couple minutes? No, it did not. Shorting this pair, okay, looking for shorts in this pair, at logical levels at premium arrays, you're going to see that this one offered better delivery of price on the downside. While it still moved up in sympathy, it's been measured. It's been really reserved in terms of its willingness to pop up higher. In other words, all the movement up, okay, has been stunted. Okay, it's been held at bay versus what we're going to see in cable. And that's what I was trying to draw your attention to on the weekend of the 4th, because that recording I outlined, the focus or premise I had was upside leadership is going to be in cable. Okay, British pound versus US dollar. That was the pair to see upside movement and outperform the euro. Okay, we saw that happen. So now, while that's wonderful, I want you to go and look at how we see price delivered on a 15-minute time frame. All right, so here's the 15-minute time frame, and this is last week's trading. Price did rally. We got a institutional entry drill trade here. You can basically paper trade that. But watch what happens in here. We have the market break down, rebalance, sells off, rebalance. Really nice sell-off. Where's it going to? Over here to the order block. Right there. Okay, so it's trading inside the order block there. Sell-off at a SIBI. Aggressive sell-off. You don't want to be buying this one, but any shorts that occur, study the dollar in this area right here. Do this for your own homework. You don't need to share anything with me. You don't tweet it to me. You don't send it to an email. It's for your own study. If you're rather going into your own study journal and recording your observations. Don't think about in terms of, is this right or wrong? You want to write your annotations down, okay? And then as you go through weeks and months and years of looking at price action, you're going to see things because of repetitiveness, okay? When I say, go in here and study for homework, I'm not asking you to send me anything, okay? I get a lot of emails already, and some of you get impatient, and then you write urgent in your email title, and they're not urgent, okay? And some of you are abusing urgent, okay? Urgent means there's something wrong with your account, you can't get in. Most of the times, it's just simply corrected by clearing your cookies, clearing your form data on your browser, or using a different browser. Or you didn't pay your payment, and you got disconnected because of that. They're the only primary reasons why you don't have access, because we generally don't do anything with people's accounts unless they're banned for abuse, sharing, or reteaching it or something to that effect. But when I say do your homework or do homework in this area, like I'm saying here, you want to go into it and collect as much data as you can on a daily, 4-hour, 1 hour, 15-minute, 5-minute, 1-minute chart relative to the dollar index here. Okay. Remember what I said on the weekend edition of the 4th of April. That recording, I said better shorts in euro, better longs in cable. Upside leadership is going to be in British pound uses versus US dollar. All right, so while we do have some upside movement here, okay, it does run some buy-side liquidity. Yes, this is a sympathy move. It moves in sympathy with the upside leadership in cable. While this is occurring, okay, leadership in cable is going to be outperforming on the upside. So it's not, okay, well, yeah, it went up and I'm smart and this is ruining ICT's general rule of thumb, and what he's talking about isn't ironclad and it's not true. Watch what happens when you look at the 9th on cable. And again, I said this to you weeks ago, okay? So we have buy-side liquidity resting here, and they pop above that, and it breaks down. We go into the breaker here and sells off. Rebalance, sell-side liquidity in here, and we have an imbalance rate there. Boom. Price trades down into it here, gets below here, and let's put a little line on that, and we trade into it here. And then ultimately, this is where we're at right now. So we have better shorts in euro, even though it does move up in sympathy. It doesn't compare in terms of the delivery of price on cable, as we'll see now. Let's go over to cable. All right, so here's our daily chart on British pound versus US dollar, or cable. And I mentioned that we would likely pull up if we had a weaker dollar and we had upside leadership really come to fruition on the cable market. we can see it potentially trade up into this level. That was my upside draw. So to get to that level and through it, then we have a small little area in here that rebounds to the bearish order block there, and then we have buy side liquidity. That's a little overzealous even for my liking and taste. I said that it's probably not likely to happen, but if we do get any upside, it would probably draw to this level here, which is the midpoint of the wick or tail of this down closed candle in the form of consequent encouragement and gap theory. And you're probably going to look at that, especially if you're new, and say, what did you just say? Just go through the commentaries and you'll see that I'm actually teaching all that stuff. So trust me, even month one people have access to that. All right, so we had the market trade back down into this area here. I said this is a balanced price range in here. It didn't need to go anything below that. If it did, it would go down to this level here into the imbalance. But at that, I didn't think it would do that. And in fact, on the, what is this right here? That's the 7th of April. On the 7th of April, we went down to consequent encouragement of this SIBI. Okay, so sell side imbalance, buy side inefficiency, or in this case, the fair value gap. That gets rebalanced here. Then we trade back down again. This becomes a balanced price range. Okay, what does that mean? Back to the idea I outlined on the daily chart for the dollar index. This is exactly what I was anticipating happening, just in reverse for the dollar index daily chart. Okay, go back and listen to my recordings, most recent 2 or 3. This is just the reverse of that. So we have the gap here that gets rebalanced here and then gets completely balanced. In other words, we have a balanced price range here. What do I mean by that? Price was offered here with one single candle between this candle's low and this candle's high. That in itself is in my theory, in my teachings, in my understanding, that creates a fair value gap. What that means is this single candle passed through between this candle's low and this candle's high. That segment of price action was only offered predominantly as price was going down. In an efficient market, okay, you hear the terms like auction theory. While auction theory has a lot of good points, it's incomplete. Okay, it's incomplete. The reason why it's incomplete is the idea of just auction theory doesn't answer all of the missing pieces, if you will, of why a market should return back to a specific level. Okay, and even Chris Lorry's work, as much as I have respect for the gentleman, his doesn't touch on this either. When Lorry talks about liquidity voids, and you can look at his stuff on YouTube and get all this stuff. It's not like I'm teaching his paid course content, because I don't know what that even is. But if it trades up to here, okay, he's basically, his terms is he's done. It's done. That one's done. Next one, okay. That's number one where we divide from. Okay, if we're at a crossroads there, you're going to stop with this one with Lori. Okay, with me, we are not done with this. We are looking at this with the expectation it becomes a balanced price range. That happens here on this candle. It opens, trades down one more time. So all of this area in here, all of this price action right in here, this single down closed candle, that's the range I'm looking at. It gets rebalanced when it does it with this candle here. Okay, all of this right in here, this one big candle, once it gets there, it's now filled in the buy side. Now it becomes a balanced price range, okay, when we trade back down again. Why? Wasn't it offered here? Yes, it was offered here on this single candle, but it was offered in such a way it was inefficiently offered. So it leaves porous gaps. Okay, every price level from this candle's low and this candle's high, that range that I'm shading in here, all of the prices that it was offered as it was going down was inefficiently offered. So there wasn't enough of the buy side or the ability to offer buying inside that range. Okay, and again, just to exaggerate the range so you can see what I'm looking at, it's this candle's high and this candle's low. That creates the fair value gap. Okay, by itself, it means you nothing. Okay, it just means that it's worth looking at. But on this particular candle, it becomes a rebalanced, rebalanced price range. But now it continues and morphs into a balanced price range on this individual candle. Let me get this box here. This individual candle, this big one here, that low, it trades down to the low end of that range again. There, So what becomes a rebalanced range now becomes a balanced price range, because now it does not need to go any lower. It's offered downside with this one single candle, creating an imbalance. This candle rebalances it. Then at a later time, it comes back down to it again. That range now becomes balanced. What do you do with that information? Well, as I've been teaching, if it ever trades down to the middle of it, okay, or consequent encroachment, which is the midpoint of the gap, okay, not mean threshold. Mean threshold is specific to an order block concept. Consequent encroachment is the midpoint of a balanced price range, okay, or a imbalanced range. Same thing, midpoint, all right? If it trades to that at a balanced price range, it should not trade through it. And here you have it, okay? This is the logic in action. I was not here with you all. It's the same rules, it's the same context, it's the same premise, and it's all algorithmic, okay? It's not in books. Mr. Lori doesn't teach it. Mr. Seiden over at Online Trading Academy, the supply and demand folks, guys, all those people, they don't know anything about this. You all know more about price delivery than they do. Trust me. Even if you're month one, if you watched every commentary I've put on the forum and you've digested month one content, you know more than these guys. Trust me and believe me when I tell you that. Okay? It's not an arrogant statement. I've put so much into just what I've done in commentaries, and in month one, it blows everything else out of the water. It cannot stand with what you know now. Nothing can stand with what you know. It doesn't compare. Okay? But this is exactly what I was looking for the daily chart on the dollar, but in reverse. Okay? So we have it here. Price delivers a run above the equal, relative equal highs in here. And now we're going to see if it wants to draw inside up to this SIBI, or the consequent encroachment of that, which would basically be around just below this low here, because it could trade up to this low at 27.26. But my liking, my personal taste, is this level here. And it's because it's the consequent encroachment of the tail of this particular candle. And again, I'm not going to go into all the details there because I taught this in the commentary. So I'm going to take this off because it doesn't belong on the chart anymore. It's accomplished the method. So we are seeing upside delivery and outside the scope of what was offered in Eurodollar. It's been outperformed with the cable market trading higher. And we'll see if we get a weaker dollar and if we get the expansion to this level up here on the daily chart. Let's take a look at the hourly chart. All right, so here's hourly British pound versus the US dollar. And you can see we had a run below relative equal lows and rejected. And just to jump to the underlying premise was leadership on the upside was with cable. Okay, cable's only went up like 100 points or so. Cable's gone up over 200. Okay, really, if you count back here, it's over 300 points it's traded above. Okay, and we have buy side liquidity right here above the relative equal highs. We've swept through that, and fair value gap, we trade down to it, rally. Okay, we have order block, trades down into at, rallies. We have a fair value gap here that still resides and didn't get quite down into that. And we ran below an old low. Sell side liquidity was taken there and rallied. Fair value gap here with a breaker. Here's the low, high, and lower low. Up close candle between the low and the lower low. This is a bullish breaker. We see it trade down into it here with a fair value gap. By itself, that's a model. Put that in your notes. If you can see a fair value gap coupled with a bullish order block or a bearish order block, and you have the directional premise in mind, and it lines up with institutional order flow, you have a complete trading model. That's it. That's all you need. That's all you need to find consistent setups on any time frame, every market. Okay? I got a lot of new people in here like, hey, can you just give me something I can start practicing with? Right there, there's one of them. Okay? There's so many more. Okay? So many more that you're going to learn. But you need to start with one. Even if it doesn't feel like it's the right one for you, you need to exercise it. Go into the charts and see how many times you see it. And it will convince you right away which one you should be looking for. Because the one you find easily, it jumps off of the chart just like that. You may not have gotten to the concept that most likely agrees with you yet. But when you do, you'll know, because they're like, that's the one that makes sense to me. Okay? Just, it's not always order blocks. A lot of guys come in here and gals come in, I need to learn the order block. Okay? And they quickly learn that there's other things in here that complement order block, and it just means a whole lot more to them when they see the other things, that they learn here. But we have, like I said, fair value gap here in the form of a BSI, buy side imbalance, sell side inefficiency, with a bullish breaker and price rallies. The time of day here is the New York Open. Price rallies up, consolidates, and then expands above the buy side liquidity pool, resting over here. If we drop down into a 15-minute time frame, you're going to get a better appreciation for how price delivered strongly on the upside with this pair. And look how much more energy there is. Every time the market rallies, it's a lot more willing. Okay, there's a lot more energy when it goes up versus when it starts to go down. It's muted. Okay, it's stunted. Much in the same way the upside was for Eurodollar, the opposite is seen on cable. And every time it's allowed to rally, it really does so like gangbusters. It just wants to go. Yes, there's consolidation, okay, but every time it rallies, there's a lot of momentum on the upside. Now, if you go back and look at the price action between, and I'll let you do this for your homework, get about the 7th. Yeah, let's put the 7th up to recent price action, okay, at the time of this recording on the 13th. Contrast and study how all the highs and lows match up with Eurodollar on its 15-minute chart versus the cable chart. And you'll see what I mean by that. There's much more energy in the cable wanting to go higher versus the upside offered in Eurodollar. Okay? And again, go back, revisit the video I gave you on the weekend of the 4th of April before we had our break for Passover week. I told you that this pair here would have relative strength to the upside. Okay? So that means shorting, ideally, if there is strength in any time that the dollar was going to give you a pop or bounce higher, shorting Eurodollar was the better short, not shorting cable. But going long pound dollar, anytime dollar went lower, look at those instances. Look at every time like this one here on the 9th. Okay, look how much more energetic that is. It's beautiful, and it's running off of a bullish order block. Much more energetic, much cleaner in delivery of price. It's just more pronounced. And yes, there's consolidation, but who cares? That's not what I'm talking about. I'm talking about the amount of distance and magnitude the price move occurs and the direction. And that is stated beforehand with cable. Cable was the leadership superstar, and it's done so. Is it done? I don't think it is, and we got to go back to that daily chart in the comments I gave you relative for this pair to get to where my expectations are. I don't think until we completely fail and break down on the daily chart that this pair is done. I think it still has upside. And I still think it has upside in a surprising context. I think it might pop more than it should. In other words, it should be overdone. Okay. In other words, I'm expecting some kind of a swan event. And I can't really put my finger exactly on what it is. I know I had a member, one of the ladies asked me in an email, can I share where I get my news from and what's trustworthy and what's not? I kind of digest a lot of stuff. I mean, I look at Bloomberg stuff, Reuters. I look at the main things like Wall Street Journal, Barron's. I look at what is being pumped out, and I know how this comes with experience, and you learn these things conceptually here, but the experience factor you're going to pick up on your own by doing it. But there isn't this magic resource where I go to and I get things. Okay, I got a lot of people also asking me, where am I getting my information from? Because my information is ahead of where they're getting their stuff from. It's really just basically me taking the information I see from major headlines and then plugging that into sentiment ideas that you're learning here. Okay, I haven't held that back. I teach you how to incorporate things like that. Okay, and most recently with the oil market, when they did their bombing with their drones, I said right now, this is where the market is right now, and it creates the high. Those types of lessons in this mentorship are kind of like gems. There isn't where I can say, okay, go to this lesson here, and it teaches you how to disseminate the information that is readily available to everyone for free. And other places where I have to pay more for it, but you end up finding the same information. It's just the experience factor is what's missing, and then how this could be used as a smokescreen, or it could be used to complement an underlying premise or sentiment idea in the marketplace. Last week, before we broke, I just simply didn't know what to do. I had too much information. I had information overload. I was looking forward to taking time away from the marketplace, so there isn't, like I said, there isn't one particular resource, and most of it is readily available to everyone. What you're getting is my breakdown mentally and with experience, and I'm not always right. I mean, for the folks that have been here since 2016, I've been wrong a few times, okay? And it doesn't change any continuity or consistency. It just keeps me from having 100%. You're not going to have the ability to look at the same headlines or the same information points that is being pumped out on a day-by-day basis that you come to the same conclusion I would. And I have a little bit of a conspiracy theory vein that runs completely through me, and it has been since 2001. It may not be as such a big deal to all of you or some of you. And for others, you probably are much more conspiracy theory based than I am. Okay, and I don't have any problem with that either. But I think, Zoe, if you ask me, what resources do I use for news and all that, I pretty much listed them here in this last 5 minutes. All right, so and again, just to reiterate, I don't think Forex is done. I don't think that even with the digital dollar coming out, that Forex is going to be done. It may be some major changes down the road, but it would take something, biblical for all the currencies and all the countries to say, you know what, we're going to throw our currency away and we're just going to follow one, and if that happens, we have bigger problems to worry about than, whether we're going to trade Forex or not. There's going to be bigger things to worry with. Right. So I'm not trying to diminish the likelihood of that happening, because I don't know. Okay. But it certainly looks like we are in the beginning stages of all that type of thing. But it's going to take a whole lot for countries to say we're going to follow that currency and do away with our own. Okay, but I'm watching all those types of things, but don't be in a rush to try to throw Forex out the window. Okay, because there's a whole lot of opportunity still with this asset class. And even if that does happen, the things that you're learning here are still applicable to index futures and also bonds and commodities, okay, real commodities. And if we see a continuation in the trouble that is most likely to occur in the coming months and maybe years, the commodity market's going to heat up. Right now, there's headlines that are saying that the farmers and dairy farmers are just dumping milk out. Crops are just rotting out in the fields. Whether there's any validity to that or any truth to it, I don't know. I mean, it may be, okay, and that is going to have an impact on food prices. It's going to, and crops have to be grown. They have to be maintained and taken care of. And if that's not happening, there's going to eventually be a shortage, and that shortage is going to create a high demand for a very short supply. And that's what I hinted at, before we had our break. I said, that's what I'm watching, because the commodity markets could enter, especially if we do see, continued erosion on the dollar index. That is a prime condition for bullish commodity prices. Lower dollar really sets the stage for higher prices in commodities. And if there's a real fundamental short supply, which sounds like we're getting into the early stages of setting up that whole process, and it may not materialize. So don't think it's like, okay, let's go and look at commercials on COT and look for premiums, and therefore everything's going to go start, going vertical. This could end up becoming something that we see next year in 2021. I'm just giving you the groundwork that all these things on a macro, long-term perspective, they are seeds, if you will, quote unquote, okay? not no pun intended, but these are the seed, if you will, of those future events unfolding. So it don't think that these are going to pop up. You need to be jumping in the markets and trying to buy corn and soybean and all that stuff. I'm not saying that they can't rally, but the stages that create these ridiculous bull runs where it's limit up days and you're stuck making, the full limit move, that may be a factor in 2021. Right now, we're seeing the gestation of all those things that may, coalesce into the perfect storm next year. Okay, especially if this thing continues. And we mentioned in previous recordings, or at least I did, that I didn't think this was going to be a couple weeks. They're going to ease everybody into it, and there's now again more talk of this 18-month window. 18 months is a long time to live like this. Okay, even for me, and I'm an introvert. But if it does pan out, and I don't know if it will. Okay, but if it does pan out, then the scenario I'm talking about now in regards to 2021 and the commodity markets being extremely bullish, and if we do see continuation on the lower end for dollar, man, you have unbelievable opportunity in the commodity markets. Okay, and you can do a lot with an option. Okay, you don't need a whole lot in trading futures. You can open up a futures account where you can buy call options, and just buying one, okay, whatever you pay for that premium for that option plus the commission, that is all the money you could ever lose on that trade. So while some of you may not be interested in trading commodities, or may not be interested in trading options at all, these events, these types of things are like beautiful opportunities. I mean, they're beautiful. There's always risk. I mean, like I said, the risk would be whatever you paid for the premium of the option, but it's limited to that. Like, even if the sun doesn't rise the next day, okay, you can't lose any more than what you paid for the premium and the options transaction cost. In other words, the commission that you would pay to that broker. But in theory, you have unlimited, and I'm saying this with quotations in my hands, you have theoretically unlimited profit potential. So that means, say these markets, and I'm not saying they are, but if everything I just outlined occurred, it would really be in the scope of possible, okay, where it could create limit up moves, big perpetual up moves, where it could move, grain prices could move, $10 a bushel. Okay, and that'd be a ton. Like, you're making 5 figures per contract. Okay, in the futures market, and if you get that in an option market, sometimes the option premiums multiply more than what the actual futures price is, because especially if you're buying the options during a very low volatility time frame, and if you're buying the option when a period of there's low implied volatility, and you're able to buy them out of the money, they're real cheap. Okay, in certain respects, they would be considered in other market environments gambles. Okay, and I would agree, they would be extremely high gambles. But if all the context that I've outlined in this discussion here, theoretically and hypothetically, because that's all this is, because it hasn't materialized yet, but that's what I'm watching. That's what's on my radar screen. That's the next big thing. Okay, that's the next big event that I'm watching. Okay, I'm watching for, if we do get a breakdown in dollar, and we get all this continuation in crops, not being managed, and they're just letting them die. We're the grocery store for the world in the U.S. I mean, our bread basket is a big deal, and if our crops are not being offered, okay, that's going to have a big impact on the global supply chain for food. And these markets in that environment can create an enormous bull market, like crazy profit potential. But there's a lot of factors that have to come in line for that to be there, okay? And it won't happen overnight. They won't happen like next month, or they won't happen in 2 months. It's going to take a little bit of time to get all those fundamental factors in line. Then and I'll be watching all these things, so it's not like it's not going to be a guessing game. Okay, believe me. If everything sets the stage like I'm outlining, you're going to know about it because I'm talking to you at least twice a week about these things. But they're not there yet. Right now, all that storyline is beginning where it could potentially be there. And if all those factors come together, we have a perfect storm scenario. And then even if you don't feel like you're making it here in Forex, okay, I think there's still opportunity always every single week here in this asset class. But I mentioned we would be segueing into commodities. The reason why I said we were going to start moving into commodities is because of the things I just mentioned in this discussion now, in the last 15 minutes or so. Because remember, last fall, last October, last August, okay, go back and look at my Twitter. I was dropping subtle hints about some of the things that we've been now forced into. Did I think we were going to be in house arrest for 2 months? No, I didn't see that coming. But I felt that we were in a swan event. Okay, something major was about to happen. I mean, it was so perfectly obvious. Everybody was in upheaval. All the countries, around the world, they were starting to revolt against their country's leadership. And now we're all in house arrest. We're all afraid of the virus. Okay, we're all afraid of all that stuff. And this comes with fear. It comes with uncertainty. But you're here because you want to learn how to be a speculator. You want to learn how to decipher what these markets are likely to do in the future. I believe that we are at the beginning stages of an enormous bull run in commodities. Like unbelievable, like relentless, like unprecedented bull markets. And it's exciting. It really, really, really is exciting. So even if you have hardships right now, if you have, fear about being able to make your bills or whatever, if things don't change or whatever, something like that, I can't promise that this won't line up with everyone's ability to participate. Okay, I could not. No one can make that prediction. But all of us, all of us have things that if we really had to separate from, and say, hey, look, I have this. Would you be willing to buy this from me? Okay, regardless of the economy, everyone has things that if push comes to shove, they could get rid of and raise some capital. Some of you, it may be selling a car. Some of you may be selling collectibles of some kind, cashing in a baseball card collection, or something to that effect. If what I'm describing does materialize, I'm going to put 50%, 50% of everything I have into the types of moves that could potentially be there. Not in all one place, but I'm going to just completely lay it all out there and just go with it. And I'm completely confident that if all the things that I have outlined in this discussion, if those things come together, we're going to see moves like we saw in the commodity markets back in the 70s and the 80s, where everybody wanted to be a commodity trader because those market moves were just unbelievable. Like unbelievable. Making $230,000, $300,000 in the soybean market, in the corn market, wheat market. These are all moves that happened before I even became a trader. And I have always looked at the charts and said, man, I wish we could get those types of moves. But those types of moves require pain and hardship. And that's unfortunate that's what has to come for the commodity markets to create those big moves. Someone's feeling pain. Someone's at a loss. And I'm not going to sit here and argue the merits on, being one side of the equation in that discussion, because look, everyone, all of us have hardships. All of us are going through some hardship in our life. You can all say, well, you're not having it, Michael, but I did. And I'm not alien to it. I know what it's like. But because I have now the ability and resources, doesn't mean that I can't be, empathetic to those that are now enduring or will endure it in the future. I can't save everyone. I can't fix everyone. I can't give money to everyone that would ever come to me. I would be broke because there's more people out there that would be asking me than I even have money. Okay, so we could all come up with a way of arguing about all this. Okay, both sides of the coin. But remember why you came to me. You came to me to learn how to see moves in price. And one of the biggest potential opportunities, this whole terrible incident, this whole pandemic, okay, this whole thing could be leading up to a beautiful opportunity that could completely change everything, where it's scary, it's uncertain, it's fearful, okay? All those things in commodities translates to opportunity. And that's where we're working towards. We're working towards that in mind, okay? And we'll be watching and monitoring, or I will be monitoring the markets throughout the remainder of this year. And if things start to come together, I will be talking to you about it. But just know that it's not going to happen right now, overnight, okay? It doesn't work like that, all right? So I think that's enough for this chart. And let's look at S&P. S&P, yes. And there we are. So here's S&P. Let me zoom in a little bit more. This is our June contract. So we had a little bit of an overzealous move. I think this is too much in my opinion. But if they do want to take it higher, okay, say they want to run it a little bit higher, we do have that volume imbalance rate in here. So just keep this on your charts, okay, for the June contract. And I'm going to transition to the continuous contract in a moment. But for now, keeping things salient for the actual contract delivery that you would be paper trading in, okay, or trading if you were actually trading with live funds. This would be the contract month that you would be looking at, the June delivery. And this could be where they want to take it. I personally cannot imagine it going higher than that. If it happens to trade through that, then we are absolutely in Venezuela, model, where they just kept running the stock market higher. And it's just completely, it's a joke. Okay, it's completely artificially inflated. And if it does that, I'm really not even going to touch the S&P market. I wouldn't even touch it, to trade the futures, because it's completely and utterly nonsense. But nonetheless, and some of you in here would say, oh, well, you're just mad. You're just hating because the market's really made a low here and it's going higher, and you're wrong. You just don't admit it. No, I'm telling you, it won't make any sense, because there's no country out there right now that has a solution to what's going on. And I'm not going to argue whether this is a valid pandemic or if it's really legit. I'm not going to touch on the subjects of whether or not they're artificially inflating all the death, and the flu cases have completely precipitously dropped. No one's dying of natural causes anymore. No one's dying of car accidents. I'm not going to talk about that beyond what I just said. Okay, I'm just saying that there's no country out there that has an answer yet. Okay, so arguing the case that this whole thing that we're all enduring, say it's valid, okay, and it's everything they say it is. Okay, great. What has made the stock market bullish? Because none of the companies are making money. I mean, yeah, some of the companies out there that have retrofitted their manufacturing to make now sanitizer and masks, they're making money. But I assure you, they're not making the same amount of money they would be if they're doing their own business model. Okay, they're getting paid, yeah, but they're not operating in a state of normalcy. And other companies are simply just not doing anything. Okay, they're just waiting for the bailout. So there's nothing bullish about the stock market right now, and everything here just simply suggests to me that people are covering shorts. There's a little bit of a squeeze going on, but ultimately, anything above this puts me in, I'm not even considering touching it or even following the stock market. If it goes above here, then I'm not touching it. I'm not looking at it. I won't bring it back up in the discussions until something makes more sense. And it's not because I'm mad. It's not because I'm resisting or it's not going in my favor, so I'm upset. Because it makes no sense for the index to be going up or the stocks to be pricing in. And I would wait for some future event where it would break down, and then it would create the imbalance, and then I can go back and follow it. But right now, I don't see it going above here with any meaningful movement. But should it do it, this is about where it should top out. I don't think it's going to go above 3,000. I don't think it's fundamentally there unless all this stuff goes away and cases fall out of bed and no one's getting sick anymore and they have an answer to it all. Okay, that would make it more feasible to rally. I think if they open up the economy, then they'll let it tear higher. But until that happens, this is really no justification for the stock market to go up. Just simply none. Okay, anyone that would be buying stocks right now is stupid. It's absolutely stupid. Okay, and you can quote me on it. I don't care if this thing goes to 5,000. Okay, buying stocks right now is stupid. It's not because of maximum fear. It's not because of a capitulation. It's because there's absolutely no reason to. When you buy stocks, it's based on the assumption that the company is making money and is going to continuously make money. Nobody's doing that right now, okay? No one's doing it. So there's no reason to be in here doing anything with trading. I do want to go into the hourly chart, and then I think that'll be it for this video. Zoom out a little bit. So we had relative equal highs in here. Market came down, rallied into that, cleared those out, and then came back into it. Here is our high. Right there. It's a slightly higher high here, so I'm going to put it on that, or as close as I can get my eye to line up. Good grief. There we are. It's good. So here's the relative equal highs. They clear those out. Support, 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 and rally. I don't know, like I said, if it wants to go up into that volume bounce on a daily chart, but if it does go higher, that's where I'm looking. Anything above 3,000 makes no sense, and I won't talk about S&P until it breaks down again. If it breaks down after going above 3,000, then I would have some narrative to go back in and say, okay, we've created an imbalance on the downside, so now we can look for it to refill or go to consequent encouragement and start looking for continuation going lower. Because I'm not trying to pick the top, and I'm not actually participating in trading. I'm staying to what I just outlined here. 3,000 should be the top. It shouldn't even get to that. The volume imbalance on the daily chart, that would be the area of importance, and that's seen here. Okay, so take a screen capture of that. At least it'll be in the recording now. If it does go up, that's about where I think it should go, and then we should see some kind of a reaction there on the downside. If it doesn't, S&P will move off of our point of discussions on these videos until it does what would make sense to me. Okay. Lots of sell-side liquidity resting below here. Now we have this low, just so much trailed sell-side liquidity resting in there. So one of the things that you could study, and going forward, see if we can get up into this area here and we hit that or go into it and rebalance the volume imbalance on the daily chart. If we sell off, how fast? Now this is something you want to study. If it gets up here and sells off, how fast does it make a run to the sell-side liquidity here and here? So in a context model, this is what I'm anticipating. The market trading up into this, it could hit just the low of it and it's fine, but ultimately I like to see it fill it in, and then if it breaks down, there's really no reason to go back up there. And then we want to see it aggressively sell off to the sell side liquidity and then down into here. Okay, and then it would be basically pain incorporated from that point on, and then rip on through the 2,000 mark, and then it just gets precipitously worse as the year goes on. And that's assuming a lot that this continues and we start working towards this whole narrative that's going to be longer than just this year. Okay, I personally think, and I'm going to close it after this, I personally think they're going to try to slowly work us into the idea that just expect our summer, the entire summer, to be like this. Okay, I don't think they want to reach too far out in the future beyond that, and that's why they're saying the end of this month. And then what will happen is they're going to say, well, it might go into now June, so anticipate the full month of May, and they just keep us going a little bit more and a little bit more. And what eventually is going to happen is we're going to have a lot more civil unrest, and that's going to create all kinds of problems in itself. But until we get there, we don't have to worry about crossing that bridge. I'm answering questions in the email, so that's why I'm putting it here. I'm not trying to fluff up fear. I'm not fearful. You shouldn't be fearful. All these things are going to be met with market action. Okay, and the market action, we have to decipher that. So one of the things that we're looking at is how we trade at this level, if we get to it at all. If it gets there, we want to see aggressive selling to get down below these relative equal lows, and then down here. And then I don't think it'll be, if we can get below here, I don't think it'll be like it breaks this and comes back and finds some support, broken term resistance. I don't even think it's going to come back to that. I think it'll just go through this if it gets down there at all, because it might not. We could actually be coming out of this. We could be hitting a peak, and then we've seen the worst behind us, and now it should be improving. I'm not saying I know the answer to that, but it would take that for this low not to be violated. And ultimately, even if we come out of this, where there's no more new deaths, we still have the economic fallback, that the economic fallback or fallout of what we've been enduring for a month or so. That's going to make its self seen in the earnings, and it's just we haven't seen the real impact of this yet. We have only just seen the initial psychological effect of it, with panic selling and just trying to get out. The real fallout to it will happen in the second and third quarter of this year. That's when we'll see all of this. So if you're an equities trader, just bear that in mind. One way or the other, we're going to go through this low. Okay, how we get there, okay, and in what context, I don't know exactly. Okay, but I'll be watching this level. Should we trade up higher a little bit more? And if it goes there and sells off, then my attention will be how fast we get below these lows. And the speed at which we get below these lows will be indicative of how we trade to and through this area over here. All right. So I'm playing about ear for that. Otherwise, the only thing I'm really focusing on is continuation on the upside for GBP USD. And that's where my focus resides for the rest of this week. Since we do have dollar CAD news for this week, for Wednesday, and I won't be able to talk to you after Wednesday's price action, so it will be too late. I want to talk about this one real quick, and then we'll absolutely close it. All right, so that's just what we're looking at for the Canadian dollar. I suspect that if we get some crazy news for the Canadian dollar, and then the continuation on the unemployment number Thursday for the dollar, we could see dollar CAD trade down into this area here. And if we split that in half, I'll just do it rough. And that's about it right there. So 135.25, 135.30. We could see it trade down into that. I don't see anything bullish here. I don't see it wanting to go higher. I don't see this as a bullish order block and send it higher. I think they're going to want to take it down here. And if we really tear through that, we have lots of sell-side liquidity resting below here. That could be a longer term objective if we see continuation and erosion of the dollar index. Okay, so that's the only bit of business I have for that, and I will talk with you all by way of Twitter. I'm going to try to keep it light and infrequent, but I'll talk to you again on Wednesday. I still haven't made up my mind schedule-wise if I'm going to give you a additional lesson, because I owe you one more video for last week. This is one of them, because we don't normally do a video on Mondays. It's only Wednesdays and on weekends. But I'm going to give you one more video either tomorrow or Thursday. And then we'll have the regular midweek Wednesday video commentary, and then the weekend video. So you have 3 more videos still this week. All right. And that will make up for my deficit in content from last week being off. And so I'll talk to you then. I wish you good luck and good trading.